connected with Susan, and I was just talking with Melissa Sewell about it as well. One of the things that we might do too is go to NSCA retired, because Wes is, also has retirees that probably, we can look at as well. WREA doesn't have anybody, then that would be my next. We must be talking, no, I don't need to take that, I'm just. I'll listen. So 203. Seattle South. We get through. You mean the approval of minutes? 105. Oh. I'm looking at the wrong agenda. I must have printed.
Did we get a new one? I got the first one.
All I have
Very
is,
first one, but it's the same as, I don't really.
well, obviously it's not
Do
the
you have
same
additional
because.
copies?
I have some, yeah.
Because obviously that's.
Yeah, it was last.
Anyway.
I thought I printed the wrong one. I mean, maybe I didn't, maybe it's in the number. I think somewhere. So 205. Yeah. So move 2.05 up.
You gave up this, Jeff gave up savings.
And move wellness down to here. Good afternoon. I'd like to call the May 24th, excuse me, it's not May 24th, that's what you just gave me the agenda for, is that it?
31st.
May 31st Group Insurance Committee meeting to order at 4:03 PM or 4:02 PM. And we'll go ahead and start with roll call.
Jeff Balzo present, Eric Diamond absent, Mike Dixon, Rachel Drake absent, Tony McMillan, Vicky Cooper,
Present.
Don Echeverry,
Present.
Robert Munson,
Present.
Joseph Silvera.
Present.
We have a quorum. Oh, Rachel Drake just got here.
Okay. Okay, 2.01, let's start with public comment. If there is any public comment,
There was two, Suzanne Kaiser, Melissa Swell.
okay, the ones that were sent out to the committee members?
Yes.
Okay, thank you. Okay. 2.01, presentation and discussion of the Washoe County School District Insurance Internal Fund as of April 2023 for presentation and discussion only.
Thank you. Mark Mathers, Chief Financial Officer, and actually what you have before you are financial statements for the period through March 31st of 2023, not April. As you remember, we provide quarterly financials information to you. So I will go through this rather quickly given all that's on your plate today, but I'll start with the comparative statement of net position, where we look at our net position, or most of you would think of this as fund balance, for March 31st of this year versus March 31st of last year. And if you go to the very bottom, to total net position, there you go. We sit as of March 31st, 2023 at a total net position of $25.7 million compared to $35.9 million the same time last year. So you can see that our net position, or again, what you would kind of refer to as fund balance, has declined more than $10 million through the first 9 months of the fiscal year. When I came to you last to report financial information as of the end of December, I was hopeful that things would kind of turn around, which happens a lot of times in the second half of the fiscal year. Unfortunately, I can't report that to you. We've continued to see basically the same trend of losses of roughly $1 million per month through the fiscal year. So with 9 months of the fiscal year ended, you can see again, net position has declined $10 million, and we'll go through why, but really we'll go through why. On the next page is our statement of revenues, expenses, and changes in net position, which gives you the detail on our revenues and expenditures. And so the first page here is our revenues. You can see total plan revenue year to date through March 31st was $49.125 million compared to $49.8 million last year. So a decline of $641,000 in terms of plan revenue. Those are really our health insurance premiums. That's a decline of 1%. And basically that does track the increased vacancies we've had this fiscal year. So this is in line with where our analysis would tell us we probably would be. Not that that's a good number, but fairly flat year over year, especially considering that we've had a little higher level of vacancies so far this fiscal year, which I think you all probably knew about. So if we go to the next page, that'll provide a little bit more clarity on why we've had the losses of $1 million a month. We'll start at the line total medical. These are our total medical costs. For the first 9 months of the fiscal year, those tally up to $43 million versus $36 million last fiscal year at the same period. Because again, first 9 months of this fiscal year compared to first 9 months of last fiscal year. So that's an increase, as you can see, of 19%. If you go further down then to total operating expenses, which includes the other costs you see, like the prescription drug expenses, which are up 11%, and other costs. Total operating expenses for the fiscal year for the first 9 months are $72.6 million compared to $63.5 million basically last fiscal year. So a total increase of $9 million in terms of costs, or an increase of 14%. So that is really what's driving the losses in the fund so far this fiscal year, are the cost increases. We have tried to analyze what is going on there, and I believe LP Insurance would have better information or more detailed information coming up in later today. But basically, when we look at the number of visits and our utilization and our cost per visit, really most of that increase is related to greater utilization. It is not reflective yet of increased cost per visit or inflation, we don't think. So it's pretty much tracking at 14% greater utilization, more or less, which equates to 14% greater expenses. And so again, you can see on this schedule, the ending net position for the fund, again, is declining $10.2 million, or has declined $10.2 million for the first 9 months of the fiscal year, which is a concern. We expect to transfer some funds from our OPEB trust for retiree costs, and that'll help to some degree, but it will not cover the entire loss of $10 million so far this fiscal year. And of course, we'll have 3 months left in the fiscal year to report on. So I'm full of good news, I know. If we go to the next page, again, this is just a breakout month by revenues. Again, not a huge concern here. Yes, we're down 1%, but of course we kept rates flat. So none of that revenue decline is related to any revenue or rate change. It's really just fewer participants in the plan. You can see here on prescription rebate, we accrue rebates quarterly, so that's why that number looks a little lumpish. But that's all I'd really point out to you there. And then the next page again shows you expenses by month. We talked before about how December had a very large expense of $11 million. We were hoping to see that kind of maybe even out over subsequent months, January through March. Yes, those months have fallen from that high, but not really to the extent you might think in terms of maybe there were timing differences and you might see a deeper plunge in January. We were hoping. We didn't see that. So again, expenses are the variable here, the side of the ledger that's driving the losses for the fund. The next page shows you an expense history month by month. And so you can see that month of December, again, was a near historic high in terms of expenses. And then the next page, again, shows net position. Thank you for keeping up with me. I appreciate that. So you can see, again, our net position, basically how much cash we have in this fund, sits at a little less than 26 million. We haven't been this low since the middle of fiscal year 20. So, needless to say, we've kind of rapidly eaten into our cash, which you can only do for so long. Again, we will see a transfer from our OPEB trust by June, which will help offset some of these losses, but certainly not all. That really concludes my presentation of the health insurance fund. The last 2 pages concern the wellness fund, which is a special revenue fund. Nothing, great here to report that's dramatically different from last year's performance. So with that, I conclude this inspirational presentation. I'm happy to answer any questions you might have.
Any questions?
Question.
Okay, go ahead, Rachel.
What can we expect from the OPEC trust? Can you give me like $1 million range?
Yeah, we need to quantify retiree costs. We budgeted in the neighborhood of $5 million
Okay.
in terms of retiree reimbursements. I don't have information on whether we'll get up to that $5 million, but that's basically as high as we can go. That's what was budgeted out of the OPEB trust. The OPEB committee approved the reimbursements of retiree costs just last week. So now we'll, sharpen the pencils, quantify those costs through June, and make that transfer at the end of June.
Okay, thank you.
You bet.
Other questions? So if I'm hearing this right, we're about 14%, and we've dipped in about $10 million into our reserves.
Yes.
And if you're saying we're going to get, even if we don't get the full 5 million, but we get part of that, that's going to offset that, but it's still not going to alleviate that issue.
No, if we're tracking at a loss rate, a burn rate of $1 million a month, right?
We got 3 more months.
We got 3, exactly. We got 3 more months, so we would see additional losses of 3 million if the trend holds true, and nothing is showing yet that it won't. So if we get OPEB reimbursements of, say, 3, we've just kind of broke even the last quarter, and we would see, again, a net decline of net position of $10 million for the fiscal year. If it's 5, we're looking at a loss for the total fiscal year of $8 million, if that makes sense.
Any other questions? Go ahead.
Mark, since I'm a little bit newer to this than some of these folks, could you just explain mildly a little bit more about the reimbursement process that you're talking about right now? Like, I don't even understand the fund that the money's coming from.
No, that's a good question. So state law allows a government agency to pre-fund retiree medical costs. So retirees no longer qualify, if you are hired into the district, you no longer qualify for any retiree medical subsidies. But there are employees who did. And so they are entitled to a subsidy on either the state PEB program or our own program or what have you. There's also life insurance subsidies. So those are called in law and in accounting terminology, other post-employment benefits, or OPEB. It's everything beyond your pension that a government's obligated itself to provide. So again, we kind of, like almost all agencies, have closed the drawbridge so new employees don't qualify. But for those who did and retired by the deadlines that were set in each collective bargaining agreement, there is a liability, there's a stream of subsidy payments and benefits that exist. And so what I was getting at is state law allows governments to pre-fund those retiree costs, to hold them with a actual legal trust called the OPEB trust, and I sit as the chair. And once monies are funded by our district or the governing body of any local government, they sit in that trust and they can never be pulled back. They can only be used for retiree benefits. So we've pre-funded a significant amount of resources, and we can pull those monies out of the OPEB trust if we follow the law in terms of the reimbursement requests we get to make to the OPEB committee, and those monies can then be pulled out of the OPEB trust and support the health insurance fund. It's actually fairly rare for governments to be able to do this nationally because it's a huge liability. Most government agencies choose not to fund an OPEB trust at all, and so all of those retiree costs would be absorbed in the health insurance fund of that agency through rates. So because of prudent planning by this district, we do have that pot of money, and we can access it when we see retiree medical costs like we are this year. Those assets are invested in the equities or stock market, so they're hopefully earning a higher return because it's a long-term investment horizon. And so the district budgets a certain contribution amount to the OPEB trust. Over the last several years, we've only been able to manage to budget $2 million in contributions to the OPEB trust, which again then are invested in long-term assets, and then we pull them out. Hopefully during that period between when we contributed and when we pulled them out, they're earning a very high return, equities-like return. So that's what's going on. We're accessing the OPEB trust monies to pay the district's costs for retiree medical coverage. If and when that fund is depleted, then the entire retiree medical costs would need to be covered through rates and funded on a pay-as-you-go cash basis out of the health insurance fund. I hope, was that?
Yeah, that was awesome. So just to
Okay.
clarify, does the district fund the trust $2 million per year?
Yes, it has been higher or lower in years. It's what we can afford to do largely, but that's the current level of funding and contributions we make to the OPEB trust.
That's very helpful.
Any other questions?
Okay,
Thank
thank you.
you.
Can I make a
Appreciate-
comment?
yeah.
Just while this graph is up here. So in looking at this, we are in still a stronger position than we were 3 years ago. And that is after 3 years of no increases.
Right.
Okay. I want to make sure I'm understanding that correctly. Thank you.
Yep.
Thank you, appreciate it. Okay, so we're gonna move to 2.05, so I'm moving that up. Wasn't that what we were doing? Oh, sorry, I thought you said to move it up. Okay, 2.02, which is the presentation and discussion of the Washoe County School District Insurance Claims Experience Report as of April 2023. Lloyd, welcome.
Good afternoon, Lloyd Barnes with LP Insurance Services for the record. Robert's moving me all around the agenda, so it's all good. All right, well, we're going to carry on from Mark's conversation, build on the claims side of the equation in a little bit more detail. And then I think we're going to move another agenda item up right behind me. Is that correct? All right, sounds good. Okay, so this is our claims report through April. Again, pretty straightforward, our normal exhibits here. On the executive summary, Exhibit 1, you can see there employee counts are pretty flat, both employees and dependent units. Total dependents are down about 2.5%, coming in at about 4,300 compared to 44 last year. Our claims costs, again, just building on some of Mark's conversation and conversations we've had in other meetings, are up about 8.6% so far this year compared to last year at $6,034,000 compared to $5.5 million last year, which gives us a composite cost of about $868, also up about 8%. Fixed costs fairly flat at $385,000 per month versus $383 last year, for a total plan cost of $6.4 million compared to $5.9 million last year. So again, up 8.1%. Composite cost comes down a little bit off of that, right around 7.5%. So we're running right around $900 per employee. Our large claimants are down a bit at this stage. Again, we're still early in the large claimant calculation or accumulation cycle at this point. Exhibit 2, and I think this graph again just further reinforces some of Mark's comments, as well as Rachel, as well as your comment about the fund balance. I think we saw our 2018-2019 years pretty stable. Then we had the big drop off 2020, COVID, a little bit post-COVID. We then got back up to sort of our pre-COVID levels. Everything started to catch back up, and now we've seen this unfortunate, pretty strong uptick over the last 9 months as we've entered into your current fiscal year, and the end of 2022, and has carried into 2023 pretty consistently. We were hoping, as Mark said, that we would see a little bit of a downturn there, but fortunately it has stabilized so far for a couple months, but it has not turned down at all. So it seems like we've hit a little bit of a new plateau there, although it's a little early to say that. Moving to Exhibit 3, again looking at the month of April. April wasn't a terrible month. Looking all in, coming down, we had $4.6 million in employee costs on line 10, $1.4 million, $1.47 in independent costs, and then all in for the month on line 30, basically $5 million for the month, for a total composite cost per employee of $716. When we add in the fixed costs down on line 35, came in at $772.03. So when we had done some of our preliminary projections last month, they were coming in about 8.6%. They dropped down a little bit because April was pretty flat compared to the April of the previous month. So we'll be talking about that as we move into the next conversation. But overall, your costs are up about 8% year over year for the first quarter of the year this year, reaching sort of that new elevated level that we're unfortunately seeing. Just, I guess, to build on some of Mark's additional comments around some of the detail of what we were seeing, it certainly doesn't seem to be a lot of real large claims. You have your share of large claims. It just does seem to be trending on overall larger usage, overall higher utilization, more visits per thousand. We dove into some of the Anthem data recently, and it really seems to be where it's at is people are just getting back to some of their normal usage patterns and then some. So that is, I guess, the one takeaway we had with some of that data is it just seems to be overall higher utilization. Exhibit 4 and beyond, I'll let you review those at your leisure. Just jumping forward to our large claims report, which is on Exhibit 12, I think. Exhibit 12 there. can see those are large claims for the as of the month of April. We have 5 that we've been tracking over the $200,000 threshold, and then on Exhibit 13, none of them have exceeded the $425,000 threshold for stop loss at this point in time. So before we go into our next agenda item, I'll stop there, see if there's any questions specific to the claims report for April.
Questions? I just have one. You said that utilization is up. Do you think that overall inflation is hitting that? So the cost of utilization, are charges higher than they were because of that?
We're not seeing it yet. So that's, I think, good news. And Mark alluded to that as well. As we looked into it, it doesn't seem to be cost per units going up materially in any one category. It does just seem to be more units, more usage. Makes me a little concerned about where that cost per unit might go in the future. But as of right now, it hasn't reared its head.
Another question I have is, we have a lot of unfilled positions. We have fewer people, generally speaking, in the overall pool, and we're self-funded. So is having fewer people in the pool also probably inflating? So when there are larger or more utilization, is that impacting that as well? I mean, if you have a bigger pool, it absorbs it a little bit more.
I mean, your employee counts are actually pretty flat, as I mentioned. I mean, you're pretty. I think it was 0.5% a difference between last year to this year. So we haven't really seen that. I mean, I think I know you have a lot of open positions, but as far as bodies on the plan, it hasn't really changed much. There is maybe some assumption as you filled new positions, you would probably fill them with younger, new teachers, people coming into their careers. That might have some benefit to the overall risk pool. But as of right now, they're not filled.
Any other questions? Okay, go ahead.
Just got a quick question. Can you just help me better understand, when we talk about a premium cost, is that combined, for lack of a better word, all the entities like LP, Anthem, all the combined costs into one number?
Yes, absolutely it does. So again, being self-funded, as a self-funded plan sponsor, you are your own insurance company. And therefore, this process that we're going through right now, which we'll be talking about here in a minute, is the exercise that an insurance company would go through when determining what insurance premium they would charge one of their clients. Because you're self-funded, you're doing it for yourself. So we're adding in all of our claims costs, plus all of our fixed costs, which are in Exhibit 3 on lines 32 and 33. So that as you go back to line 34, those are all your fixed costs. So roughly $385,000 a month are the various costs associated with administering the plan. So that's where that number lives.
Yes, that's what I was actually looking for. Do we ever look at that more broken down? Do I miss that in our 20 pages of reports we go through every month?
It's not broken down in a whole lot more detail on these reports. It certainly is something that has been in the past and can be. You can break that up in as much detail as you want.
So just to clarify, in a nutshell, it costs us, let's just say, a little over $300,000 a month to administer the plan?
To run the plan. Yep.
Okay.
We call those fixed costs.
Yeah, correct. Thank you. That
They
was very
don't, they
helpful.
don't vary like claims costs.
Correct.
They're
Okay.
pretty stable.
Yeah, that was great.
Other questions on the claims report, cost summary?
And I would assume that the fixed costs, that includes our costs for processing claims and everything else, like
Yep.
Anthem processing
Correct. All the Anthem
claims
expenses are in there, stop loss premiums in there, our expenses in there. There's a few other small expenses in there. Again, in the context of $5 million, about $300,000, $400,000 a month. So you can sort of see the relativity there.
I had a question. Since I'm a nurse, I keep thinking about this. Would you say people are just sicker and they're going to seek more medical care, or they're just visiting more like well checks or?
I don't have those exact numbers on my, on the top of my head. I think what we've seen as an industry, this is more of a general statement versus, going back to your data specifically, is I feel like we're seeing a resurgence of people getting back to some of their normal usage patterns. And I think, and then a little bit. There has been some industry speculation that people put off care that they should have gotten during COVID for some of the bigger ongoing chronic management. And therefore they're sicker now than they would have been if we hadn't been locked down for a couple of years. I think there's some truth to that, but we haven't really seen that you've got a lot of higher cost claims. It just seems to be more of them. I don't know if that answers your question, but that just seems to be what we're seeing at this point.
Just a question, for the usage that you're referencing that's increased, pre-pandemic, is it comparable to those levels as a per usage or per person usage or above at this point?
I haven't looked at that specifically. Sorry, I can't answer. I would just be guessing. And I don't want to guess for you.
I know in the past when we've looked at this, a lot of the, what was driving rates was a lot of high dollar claims, the big claims, and we're not seeing the big claims. We're just seeing the more utilization across the board, whether it's going for the colonoscopy or whatever it happens to be that's costing more, but people are just getting back to, so.
Right, and not to say you didn't have a lot of big claims last year. You had 29 claims over $250,000 or over $212,000. That's a lot of claims over $212,000. So you still have a lot of those. What I was alluding to there is it doesn't seem to be you having a bunch of $500,000, $1 million claims. It's not those really super big claims that sometimes can really cause problems with your plan.
Okay. Well, we'll go on to the next item, which is, that's 2.05? Okay. And this is for possible action, so should I take public comment before I open the item or after I've opened the item and before discussion? Okay, so we'll open 2.05, presentation discussion on possible action to provide a recommendation to the Board of Trustees of changes to the Washoe County School District's health plan to include a premium rate increase and addition of orthodontia coverage in lieu of a third preventative dental cleaning to the dental benefit for plan year 2024. This is for possible action. Is there any public comment on this? No? Okay. And I do know committee members did receive some public comment. Hopefully you were able to read those. Okay.
I'll give it a start. I do have a few things for orthodontia. I thought we could just take a quick look at it beforehand. Not that this needs to be discussed before rates, but just to have it in mind while discussing rates. So benefit enhancements aren't generally done or brought to committee during a year of a suggested rate increase. However, we did take a look at the orthodontia benefits. It has been something the committee has discussed in prior months, and this would provide an enhanced orthodontia benefit, potentially in lieu of a third cleaning option that we have within our plan. That is, I don't want to say it's abnormal, but it's definitely more enhanced than I think some dental options of just the regular 2 preventive cleanings per month. So per year, excuse me. So Anthem was not able to attend today because of our rescheduling. However, they will be on our next meeting. If we do have additional questions with this, I certainly can bring that back and we can answer those questions, but they have brought this analysis forward to us. So again, our current plan has 3 preventive cleanings per year and exams with that. 3 different options that we've looked at is if we wanted to add $1,000 child-only orthodontic benefit with 2 cleanings and 2 exams, the cost would essentially be around a wash or no increase to the claims. If we wanted to add $1,000 child ortho benefit with keeping the 3 cleanings and 3 exams, it's approximately a 2.32 increase to claims, around $123,000. Or obviously an option would be to not add the ortho and not change our current plan. We had approximately 1,441 members that received 3 cleanings in 2022, and that paid amount was $119,000. So again, this is not necessarily to discuss right at this moment, but just so you have this at hand while we're making the determination on the rates.
Tony McMillan, for the record. One question, Laura. We discussed last time I was here, I'm sorry I missed the last meeting, going down to possibly 2 cleanings, and yet we're adding ortho. What is the option for, considering a rate increase, to go down to 2 cleanings and not add the ortho?
Okay, I'll work with Anthem on that, and we can bring that answer back on the next meeting.
Other questions, comments on this? Yeah, go ahead, Rachel.
Is the 2.32% increase to dental claims? Because increase to total claims seems like that number's off.
It's dental claims, you're
Okay,
correct.
thank you.
I will say that I know this has been something we've discussed as an insurance committee for years and years, and we never really got to a point where it'd be a wash. And I think last time you said that there was only about 1,000 out of 8,000 employees that, or what does it say? There were 1,400 members that received a 3rd cleaning out of, 8,000 plus their dependents are on here as well. So we're talking, it's a small percentage receiving the 3rd cleaning, versus I do know that there are a lot of people with children who need orthodontics, and I think that that's something that we might want to keep in mind as well as we're looking at this. But it has been something I know years ago this was brought up, and it happened to be a year where there was increases and we just walked away from it completely. But I do know that we've had discussions about this for years, and I know we've gotten a lot of member feedback on that as well. Other questions or comments about the ortho? Yes.
Are we talking adding a $1,000 ortho benefit per year or per child?
Per year, per child.
Okay, thank you.
Any other questions on the orthodontic? Sure. Okay.
Okay, am I on? Yeah. Okay, other than that, we'll move to the rate projection sheet that everyone should have. That shows a potential rate projection of an 8% increase. And I will probably hand it over to Lloyd to help explain the projection. You, of course.
Thank you again, Lloyd Barnes with LP Insurance Services. Going back to the question on the ortho, Laura, we might want to just double check that with Anthem, because usually how that is, the ortho benefits are per lifetime per person.
Okay.
So it might be just something worth double checking how
Thank
they
you.
did their calculation.
Okay.
All right, so building on Mike's question from earlier, this is the exercise that an insurance company would go through to determine what premium would be charged to their clients, to the insureds. When you have a self-funded plan, you're doing this for yourself. And so we go through this exercise this time each year. We've been working through this for a couple of months now, trying to hope that things got a little bit more favorable, which they did. As I mentioned, they came down. Our original projection came in actually at 8.66%. That backed off a little bit to 8.03. So our exhibit here is coming in and showing 8% financial mathematical calculation to fund claims for 2024. This is the rate grid we've provided to the district each year, just the breakdown on how the different categories of rates would work for the different plans, with all the different elements of that build up the rate. But you can see there, when it all adds in, it actually comes into about 7.7, 7.8% overall impact to cost for all costs. So again, that's where we're at this point in the game. I'm happy to answer questions about the methodology or anything, for the building off of what we go through every year.
Go ahead, Tom.
Lloyd, when you determine these rates, or this rate recommendation, I guess, is this trying to balance our fund to stop going down, or is this trying to allow for a little bit of an increase, or maybe still a little bit of a decrease?
Very good question.
I know it's a crystal ball, but
Yeah, no, very good question. They're two separate processes. So what Mark and the finance team do is track, manage your revenues and expenses, right? That's what they do. Our exercise from a underwriting perspective is one that has a lot more crystal ball in it, and we've talked about that in the past. It is more of a projection. Well, it is a projection, and it is a mechanism where we look at the most current data that we possibly have, what we believe is the most accurate data of where your costs have been. We try to guess what they're going to be in the future, and then compare them against your revenues. And that's what this percentage becomes. So it is your claims cost. What do we think they're going to be in the future using inflationary trends? We actually use your trends. So we're actually using quite a bit lower numbers. We're using 2.55 for medical, 6.21 for pharmacy, and 0.9 for dental. Those are our trend factors we're using. These are actually one of the lower numbers we've used for you in a while, which is good because you've had 3 years of pretty flat claims expenses. In years where that has been inflating, those inflationary numbers have been higher. Add in the fixed costs, and then compare that to revenues. That's where you get that. So to answer your question, when you do the math on this 8.8% increase, it's actually I just did it on when I was sitting down. It's right around $7.5 million in additional revenue, which is shy of the $1 million a month that Mark alluded to. That is the burn rate, so to speak. But you can see it starts to offset that. But again, we're looking at it purely from what do we think costs are going to be next year in our best guess, and comparing that to the revenues and making that adjustment accordingly.
I'd like to add a little bit to that. Sorry, you want to
Yeah, no, go ahead.
If I remember right, and Jeff, I bet you do, when I kind of came along, we were having this conversation a little over a year ago. So if you're saying the total premium, forecast projection is 863 for next year for just the employee, correct?
That's correct.
Okay, so if we go back to this fiscal year, total premium was 802. But if we go back one more fiscal year to 22, this group decided not to have a premium increase and to instead absorb that additional cost through cash reserves. So on paper, am I correct that the 802 is actually not the premium people are paying right now? It's less because we absorbed some of that out of the cash, right?
I'm happy to take that.
Yeah, you,
Good question. No, the 802 would be the same as it was previously. But think of it this way. Your costs were probably closer to 900.
okay.
So you're making up that difference that you should have been charging yourself and employees that you chose not to by the ending fund balance, by the fund balance. The fund is kicking in that additional money right now because you didn't take that adjustment and costs have gone up maybe a little higher even than were predicted. That's where you get the deficit of, let's just say, $1 million a month.
Right, and that was a concern when we did this previously, was perhaps should we absorb a little bit of that through a rate increase versus all of it? Because I think this is going to come up in the next conversation eventually when we decide next, if there's a rate increase based on still having, as you pointed out, what, 25 million, which is still, I think goes back to, I wrote it down, March of 18. I wrote it somewhere. Now I got a lot of notes. Trying to understand better. It was around March of 2018 where we had that low of a reserve. So your point that you just made there with the $1 million a month deficit in part can be contributed to the fact that we didn't raise rates a year ago.
That's a correct statement. You've been using your savings account to subsidize your cost, your expenses.
Sure. So I think really the debate that we'll all have eventually is how deep into the savings account do you want to go to offset costs? Which is what Mark was alluding to earlier, right?
Yeah.
Okay, yeah, I got it.
Because our projections, in theory, are only looking at expenses out and revenues in. We don't look at the savings account piece of it. Mark and his team focus on that piece of it.
And, I have a quick question. Does this projection here incorporate the up to 5 million of OPEB being put back into the fund? Have you taken that into account as you were doing this, or is that not incorporated in this projection?
Two totally separate processes.
Right.
Again, so we only look at what costs we're going to be and what revenues are going to be. What we predict costs to be and what revenues are going to be from both the district and employees. What the balances are, where the OPEB monies come in, that's a separate exercise.
Even though that's paying or helping to fund the retirees in the plan?
Correct.
Okay.
That might be helping pay for some of the revenue side of it. But that's not part of this process.
So it wasn't it's not part of these projections. And then the other thing is, years ago, we used to get 3 different projections based on confidence rate. What confidence rate is this projected at?
This is basically a 50% confidence factor. So, again, and Robert is doing some throwbacks for you all that are new to this committee. A confidence interval or confidence factor is the likelihood that this number's right. Okay, and we're using basically a standard. We're not adding any margin to it. So what we used to do is we used to try to get a higher probability that the number was going to be right and not be at least enough and not too much. And so the way you do that is you can add a little bit of margin. You can add a little bit of buffer, a little bit of cushion. The more cushion you add, the more likely you're going to be right and not wrong. Right? So this one is, we consider this flat, which is basically 50%. When we used to do it before, we used to do 50 and 75. We used to add, I think it was 2.5% margin to it. So that would take this up to about 10%.
I have one more question.
Go ahead.
Just to be fair, I did say my last question was a little question. This one might be a big question. But don't feel like you got to go super deep. When we get to this conversation, I don't understand why we are self-funded versus fully funded. if I could just get a brief understanding of that, because when I look at the cost, I mean, I wonder, like, are there other options that would be more wise for us to explore just with the size of our organization? So if you could just help me better understand, and I know that's a really big question, but if you could just give me a little bit of info to learn, that'd be great.
That's actually a very reasonable question. And I will only take, let's go with 3 hours to answer this one. It's actually one of my more favorite conversations I have with our, especially our public entity groups, because it's a really reasonable question. So buying insurance from an insurance company is very, very rational, very reasonable. The larger an organization is, public entity or private company, the more predictable their claims can be, and therefore the more they can potentially, if they have stable finances and they have solid revenues, they have fairly stable population, the more they can decide that, you know what, we don't necessarily want to pay an insurance company to do this. We're comfortable doing it ourselves because we know that insurance companies are going to take profit. We know that insurance companies have to pay premium tax. And we know that generally they're not maybe as efficient as we can be in a self-funded world. So many larger employers, and when I say larger, 250 employees and up across the country, choose to be self-funded so they're not paying an insurance company all those additional costs. Because at the end of the day, we say something in our industry says the claims are the claims. The claims are pretty much going to be the claims whether you're insuring them yourself, you're buying an insurance product from Blue Cross Blue Shield or Aetna or Cigna. The claims are still going to be the claims. And so it's a matter of what layers, what additional expense items do you add on to that? Now, could there be an insurance company that wants to subsidize your costs? Maybe for a year, but then you potentially would lose control over the costs in the future. That the common thing would be an insurance company might come in, decide that they want to give you a really great deal year one to get your business. Now you're with them, and now maybe the costs go up more than they should. Again, I'm not saying that would happen, but it does happen. So again, most larger public entities are self-funded if they're stable and financially stable enough, because it allows them to keep those costs as low as possible in all of these different items, in all of these different line items.
And I just want to add, the last time we looked at insurance years ago, we did actually have some companies put in what they would charge to take over, and they were at least where we were at or higher than where we were. And Lloyd's right. Once you dismantle this whole process, it's really hard to go. Sorry, I keep doing that. Hard to go back to self-funded, and then you're at basically the control and whim of the insurance company. Yes, you can always switch to another insurance company, but you're out there getting bids. You're not able to really control. Like, we can sit here and say, you know what, let's do this or do that, or let's change our benefit plan so that we don't have to do as much here. We added an HSA. We've done a lot of things like that to control costs, but we don't have that control if we go to an insurance company. And like I said, we did have, I think it was 2 companies that gave us rates might have been 2, I think, that gave rates for that in the RFP last time, and they were actually higher cost-wise.
Very good questions.
This is a question a little bit related to the public comments that we did get, but is it possible to have a different rate, like retirees have 0 increase, employees have X increase, employee and family has a different increase? Is that a possibility? Not knowing what any of those are, but is it even possible?
Not really. I'm not going to say with absolute that it's impossible. There's an NRS requirement that all Nevada public entities, all Nevada local governments have to blend their retiree and active experience for rate setting purposes. So when we go through this exercise, we have to blend it all together, determine what the rate is. Technically, you could lower the rate for retirees, but you can't charge them more. I don't know why you would, so to answer your question, you could, but I don't know why you would charge retirees less, because they're usually more expensive, right? Their retirees as a population are going to be more expensive than your active population. So I guess technically you could, but there's no practical reason why you would in Nevada. It's not really allowed.
And
Did that get you there? Or you still look a little, I don't feel like I got you all the way there. Okay. Okay.
And Lloyd, I do know that came up when we were looking at like Medicare Advantage plans and things like that, because we weren't allowed to offer anything that's different in coverage, right? So you can't offer a plan that covers more or less to retirees than what you're already offering to your actives.
Well, you can offer it, but NRS says you have to give retirees the ability to elect the same plan that the actives have. You can't penalize retirees in Nevada, I guess is the best way to put it. And not all states are like that. Some states allow you to do that. But in Nevada, we have requirements that basically says we've got to treat retirees essentially the same. We can charge them less for, when they have Medicare, which you do, but you couldn't charge all your early retirees 25% more than everyone else. That's not allowed. It's talked about a lot, but not allowed.
One thing I do want to say, though, is that when we have, and I know we have a lot of new people on the committee, if there is a rate increase, according to the way things work with our bargaining units, typically that's absorbed automatically by the district for the employee. But it's not for the employee's family costs, or if you have kids or husbands, wives, spouses, your kids up to 26 on there, that's not absorbed. That's going to be a rate increase for our members for those people. And it's not absorbed at all for the retirees. They take the total hit. So if you do an 8% increase, they're on a fixed income, and now they have an 8% increase completely. So just want people to understand, because I think, a lot of times you think, oh my God, I'm going to have, no, I'm the only one on my plan. I don't have to worry about it, and I'm good. But I also have to be cognizant that the people we represent have families, and they're going to get hit, and our retirees are going to get hit. So just to keep that in the back here.
How many folks benefit from the retirement plan?
Looks like as of right now on Exhibit 5, you can see retiree counts are 739 retirees with 285 dependents in that group.
Okay, so just to add on to what, Robert, you were explaining, if you go back to the premiums then, if you're a retiree and you are a +1, I didn't think about them having a dependent, are they covering the full cost of like EE plus spouse? So for next year, is that $1,355? Correct. Got it.
And this one probably Mark might have to answer, but where is the district overall related to employee negotiations, and what's their plan to have those completed?
I will definitely defer
And is
to
that
Mark on
and
that.
then
Or someone else.
is this an important topic prior to completion of negotiations, or
The district
can
covers,
we wait until after that?
The district covers that for the family, or for the member, though.
So we've just started negotiations with some of our associations. Some of our associations have not had their first meeting. So that's where things stand currently.
Mark, am I correct that none of our associations cover family members, do they, automatically, or do they have subsidies?
That's correct. All of our associations, collective bargaining agreements provide only for coverage for the employee-only cost.
Done.
And I just want to ask a clarifying question. This committee actually is the bargaining of insurance. You guys do not bargain insurance in the collective bargaining agreements.
So I'm looking at Mr. Pick. This is the entity that collectively makes a recommendation for rate increases that then the board has to approve. So in essence, right, you are the extension of those associations when it comes to determining the share of, right, the rate for health insurance going forward. Yep. Go ahead.
This is Vicki Cooper for the record. So will there be a time in the future where there's no retirees on the health insurance, or I guess I don't know how it works yet.
Doubtful. Because again, as Nevada law allows for retirees to retire from their employer of last employ. And so they can stay on their health insurance under whatever provision. There's some other provisions with retirees, but it'd be very unlikely.
Go ahead, Rachel.
Okay, so with this committee, we have spent much of the last several years going, okay, we want to make sure that we take care of our members, and we want to support people where they're at, recognizing that costs are going up in every factor of our lives. And we knew we were going to be taking a net fund hit this year. We knew that coming in. We didn't know what it was going to be, and it's a little higher than we expected. And still, I would like to say that 8%, even though that is the change that we have been experiencing, I would like this committee to discuss something lower, knowing that it will still eat into our net fund balance, which remains higher than we've seen it in most of the last decade.
And, okay, I was just going to ask, in the past, we've also looked at coverage options in relation to this, like co-pays, things like that. I don't know that there's much of an appetite for changing benefits, but I'm just curious, are we going to look at that as, what that impacts? Because I think if we understand that, 1% here or 5% or 3%, most of them don't make a huge difference in plan changes, but are we going to be looking at that?
If we do look at those, like you said, most likely the rate projection will change. We haven't been looking at that beyond the ortho. The only other thing that maybe we would be bringing later on throughout the year would be anything that would enhance the plan, but would either be at no cost to the plan or a very, very low cost at the most. So we're not looking at like deductible changes, co-pays, out of pocket, those larger changes.
Jeff?
For the record, Jeff Balzo, to Rachel's point about looking at possibly looking at a lower rate increase before I get to that, it sounds like we're just kicking this around today, but not making a decision. Okay. Then for the next meeting, Lloyd, could we get some sort of chart that shows the long-term impact of the lower rate increase, let's say like 5 or 6%, but showing these 8% cost increases in the future, and see how long we have the net position in the fund to draw down on?
We can certainly do some modeling around that. the further you get into the future, the bigger the dart throw.
Well, right. And
But yeah, I mean, we can certainly look at putting together some things that might help with that exercise.
Right, thank you. Yeah, I understand that several years out might be difficult or anything beyond 1 year, and then we haven't even, I mean, this is just based on higher utilization, and we haven't even factored in inflationary rates that will be coming in the future. All right, thank you.
Don?
And while we're looking at things, it would be nice if we went back to what we used to do and got to look at, if we moved everybody's deductible $5, what does that do? Because we've seen that there has been times, if we did a slight increase to something, it kept the big premium down. So it'd be nice to kind of see what a value in our product we could do. We've looked at those in the past, right? And we've had some high costs come to us several times that we were able to work through and bring to something we could afford. So I would like to see that again too.
I'll defer to Laura and how they
I
want
just
to-
wanted to clarify the very first part you said about the deductible. I didn't catch that. I didn't hear it.
So in the past, when we've had high percentage rates come to in front of the insurance committee, they have brought us different graphs that shows if we were to raise deductibles or in prescriptions, what that might do, that might knock off a percentage of where we needed an 8% might go down to 7 or 5. If we were to make a different change to our plan, there was some value to taking percentage off. A lot of times they're not big, but sometimes that cost is a lot smaller than a big increase across the plan.
Go ahead. And this is for Rachel. If I hear this right, you said the 8% is a value of about $7.5 million,
Yeah, yes.
and we're at 10 million, but that doesn't take into account OPEB, which is probably 5 million. So in theory, if we get all 5 million of OPEB, maybe we increase 6%, we would then be flat as far as a fund, if my math is correct. Mark's shaking his head, but
As long as Mark's shaking his head, we're happy.
But the
he's
five-
shaking it.
Oh, he's shaking it the
Yeah,
other way.
It was the wrong way. But the 5 million is kind of a one-time thing. Because you said you only funded 2 million a year, right? Just to better understand that.
Yeah.
Yeah, I mean,
Right.
just to clarify, I think,
Yeah.
Tony, why I'm shaking my head no, not quite, is because you didn't factor in the loss in the last quarter. So once you factor that loss in the last quarter, this fiscal year, that, I mean, just to be, yeah, we separately kind of try to reconcile LP's analysis, and we're right there with LP that we think a minimum 8% rate increase is justified by the numbers. Again, the future is uncertain, and I do have the same concern that we have not seen inflationary cost increases yet. When we have to renegotiate, right, our contracts with Renown and others, I really worry what that will mean. So, I mean, I'll just give my 2 cents since I had the opportunity, right? I agree that, you know, it's reasonable to look at utilizing fund balance, net position as a stabilization concept for some time, but the longer you put off setting rates where they need to be, the bigger the gulp is later. And I know 25 million sounds like a lot, but given the volatility that we saw this year, and as you're saying, there's no right certainty in terms of that OPEB reimbursement going forward necessarily. So I have concerns about future inflation that we have not seen yet. So we've seen greater utilization, but not the inflation to come, and it's coming, right? So that, you know, as the CFO, that would be my concern, that you want to keep steady and stable and keep up with things, because once you start losing ground, you put yourself at risk of a much larger rate increase in the future. So it's a balancing act for sure.
And my question, I guess, is that, you know, so we want to, you know, at our next meeting, we want to deal with this and then send it to the board, but this would not go into effect till January of next year. And I know the times that we have drug this out and June and July come in, we sometimes are doing better by that point, but not always, right? You know, so these numbers could change. We're basically, you know, making a guesstimate and guessing that the trend is going to continue for May, June, July, August, September, October, November, and December, for 8 more months before the rate increase takes effect. Is there a possibility of either holding off on these discussions till July or August? And I know that that's an issue. The other question, I know she's having a heart attack, or the other question is, if, for instance, we get to September and we see a decrease, once this decision's been made, we've locked and loaded, right? We can't go back. Or can we go back and make a recommendation in, say, September, if, say, things dropped off and it was, say, 6% at that point, or 5%? I know.
I don't think I'm the expert to speak on this. Perhaps Kevin can help, but is there a way they could recommend a recommendation to the board again after the board approves it? Okay. So, no comment? I couldn't hear you.
He said nothing.
Okay, okay.
No way that I could think of.
Okay.
That wouldn't be able to do that.
Okay.
Can I go back to this retiree conversation just a little bit? So I think it's enlightening to know that that's about 1,000 people that are impacted. And curious if they're, you know, as I look at the different options between the PPO and the HSA, obviously the HSA is a premium savings for folks who don't need to access as much care, right? In a sense. Is there another option or a possibility that there could be perhaps even a third option or something that was for the retiree group to be able to take advantage of for cost savings for themselves? Like, is there any out of the box ideas for that?
You certainly would have the ability to create another plan that had lower benefits. What tends to happen with retiree populations is they tend to the higher benefits, not the lower benefits, even when there's a material cost savings involved, because they're the ones using the care. And so if you went from a $750 deductible to a $2,000 deductible, many of them are going to still want to be on that $750 deductible plan. So certainly can be done. I think if you did it, I think the cost savings would be such that you probably wouldn't see a lot of migration with it.
I appreciate that. Just speaking for myself, I'd like to advocate that there's at least an option so the person in the position can at least have an alternative versus being forced to possibly have a large percent increase. At least then they can make a decision. Because, I mean, that's the only feedback we got in this process was fear around a large percent increase. And the reality is, Mark, you're 100% right. Healthcare inflation is coming. And not to go down that, rabbit hole completely, but I do think this is going to be an ongoing problem long term, and we do need to find a way to budget for that accordingly.
And I think, if you figure $60 a month increase, that's a significant amount when you're on a fixed income. $700 a year is significant. I think the other thing to consider, though, is, and we can't project this, but how many retirees leave our plan because they can find cheaper options on their own? I mean, have we seen that happen? I mean, at $800, $860 a month for one person, can they go out and find a better plan or a plan that's cheaper? And I'm not saying we don't want to push people off the plan. What I'm worried about is then we're going to shrink our pool as well, because not all retirees, some of them are in their 50s and they're fairly healthy.
Yeah, I mean, you might see a little migration. I wouldn't anticipate much. Again, people that are on your plan are on your plan for a reason. And, you know, obviously there are thresholds in which they have to do something different. I respect that. But you're generally not going to see a lot of migration unless you had really big adjustment in cost. You could see maybe some people moving to the HSA option, but it's not very, doesn't work real well with retirees, and they can't be on it with, you know, it's harder for them with Medicare if they're a Medicare retiree. So it's not as commonly selected. I just think when we've seen it with other entities, your population generally stays about the same.
So now that we've gone down this rabbit hole, when this question for Mark and I guess, but do we do an exit survey to kind of know as our retirees are leaving if they're going to join our insurance? Do we do that? Someone? Sorry, that's question one. No, go ahead.
Well, we don't do an exit survey. We do reach out to all employees that we know of that are retiring to inquire if they want to go onto our insurance, let them know that they have their 60 days to elect our insurance per NRS. But we don't do an actual survey.
Okay. Because as we've seen over the years doing insurance, I'm with Robert's age limit on here, it's the younger employees, the healthier employers that keep our insurance balanced, right, as we age out. But as I look at the retirees, they're also younger than we have seen in the past. Like, they're retiring out at 50. So that also is becoming a new pool, right? That a lot of our retirees are not what we think of as a retiree anymore. So will that help in the long run, do you think? All these predictions.
Sure. I mean, a 50-year-old retiree is generally going to be cheaper than a 62-year-old retiree.
And that helps, right?
Sure. You know, that's all baked into your cost, though. You know, so over time, that will be reflected in what your cost structure looks like.
I will say that pre-medic costs, in general, cost the plan more than it costs for our Medicare employees, because remember, our plan pays secondary to Medicare. And so although that Medicare member may have more claims, in the long run, the plan usually ends up paying out less on those members.
So this process here, I'm new. Is this something you do every year? Okay.
Last few years have been easier.
Yes.
And with the Medicare, people who go on to Medicare, they don't pay the $803 rate. Their rate goes down significantly, doesn't it? Because we become the secondary.
The rate's the same. There's a smaller group from, and I can't even remember the year, but from years ago that received a small discount, like $101 Medicare discount. Some of them are grandfathered into that, but every retiree that's retiring now or coming back onto our insurance, for example, during open window that has Medicare is paying the same rate.
So if I were on Medicare, it would be cheaper for me to go on to ARPS at $400 a month as a supplement, or to get a Medicare Advantage at no cost than it would be to stay on the district insurance.
I think in general, that's what we've been seeing. Every retiree's situation is different, of course, but we've seen more and more retirees over the year opt to going to Medicare Advantage or Medigap plans that are a lower cost and probably just as benefit rich after Medicare, sometimes even more so. Mm-hmm.
So seeing no motions, do we have any more questions? Seeing no motion. As long as it's on the agenda item, yes.
Okay, so all of that discussion had, I still would hope to see this committee look at a smaller increase, knowing that our fund balance is going to, this time next year, look somewhere around probably 20,000, given these kinds of projections, unless things go totally sideways, in which case we've got all sorts of problems anyways. But I would hope that we're able to do that with the thought that as we move forward into the next year, we will probably be considering another increase to help get us closer to that. Just 8%, and even at these little fractional pieces, seems like a huge jump in a single year. And if we can adjust that down a little bit to help our retirees, help our basic folks until we get some other things sorted out, I think that puts us all in a better position, my opinion.
Yeah, I think this was one of my comments last year when we decided not to raise rates, that, would it be better to do like 2% now, and then down the road, if it's another 2 or 3% versus being hit with 8, 10, because I remember when it was over 10 that they were wanting 16, whatever. But so I definitely am concerned, and I would like to, at our next meeting, take a look at plan options, not necessarily that I want to, because one of the problems that I find when we start to adjust the plan and we start to make the plan less, I don't want to say a Cadillac plan, but less rich, at that point, I think that puts more costs in copays on our members, and so we nickel and dime them to death. And because our members are picked up by the district, yeah, it saves the district money if we do it through plan savings, but then that cost goes on to the member, versus we bite the bullet, we raise the rates, the district picks that up, at least for the member, and we keep a very rich plan, and we don't nickel and dime our members. So I mean, I know if you go from a $500 deductible to a $1,000 deductible, that $500 is more, or is almost as much as the $60 a month that person is going to, and now it's being picked up by the member and not by the district. So I know Mark's looking down, but there comes a point where you want to put those costs there versus nickel and diming people. So I do want to look at those, but I'm reticent to raise copays, especially when people go, like physical therapy twice a week for 6 weeks, and their copay, that adds up. And if you raise it $5 each time, that adds up really fast. So just caution from me. Okay. Seeing no motion, I will go ahead, as long as there's no objection, move to the next item. Thank you, guys. Appreciate it. Which I'm trying to figure out what it is. So we moved arrows. 204? Is that, because we skipped?
Yeah. We can do
Yeah.
that.
Okay, 204, presentation, discussion, and possible action to provide a recommendation of the Board of Trustees of a waiver of contribution change to add longevity requirement as one possible requirement for plan year 2024. This is for possible action.
Okay, we brought up, in our last meeting, we brought up the possibility, sorry, I'm looking to find my information here, the possibility of adding in a longevity requirement for the waiver of contribution, which is built into our plan document. We provided you the language on the waiver of contribution, and then we have brought back some additional requested stats on that as well. So this is the last 12-month period from May 2022 to April 2023. We had 25 members on waivers. And just a reminder that this is an employee benefit. So this is for when an employee is on an approved leave of absence for a medical reason of their own, and they go unpaid, they no longer have sick time or vacation time or sick bank, etc. So you'll see the different classifications that are divided out there between classified. 84% of the individuals were classified individuals and 16% were certified. The average length of the employment prior to the waiver is 13 and a half years. The shortest length of service was 6 months, and the longest length of service was 27 years. So average length of a waiver for that last year was 4.2 months. And you'll see that out of 25 employees on the waiver, 3 have currently resigned, 3 have retired, 5 currently have no benefits but are still on a leave. 1 is deceased. 7 have returned to work, and 6 are still currently on that waiver. And then out of 25 waivers, 28% have, well, this is the percentage breakdown of what I just stated. And then at the bottom here, you'll see the total dollar amounts. So the total dollars of contributions, and that is what the district has paid for these members, is approximately $78,500. Total dollars of claims that the district has paid for these members is $1,092,765,000. So the total dollars that the district paid in the year's worth of time is $1.17 million. So the recommendation was to add a longevity requirement into the waiver of contribution language. Now that we are going to a 0-day benefit wait as of July 1st, 2023. And I would recommend adding this as an amendment for July 1st. We're amending the plan document anyway for the benefit eligibility period, and we could potentially amend it for this time frame as well, July 1st, 2023. Questions?
Good, Jeff.
For the record, Jeff Bozzo. So at the last meeting, Laura, I had asked if there were other entities who offered this waiver of contribution benefit, and you said you weren't aware of any other entities that do that, correct?
I know of no entity that does this, no.
So, I mean, this is if I'm looking at the bottom of the page, the total dollars of claims paid for waiver participants, it's about $1.1 million. And could this be presented as an option as part of, or to help offset a rate increase at the next meeting of not including this benefit and saving $1 million on the plan?
Yeah, I could work with LP to see if that's something that can be worked as a projection. I'll have to speak with Lloyd about that. These are employees that stay on in the status of an active employee, so it's hard to speak to everybody's individual situation, but the majority of these employees, if they did not have a waiver, would be referred to COBRA. Then they can elect to pay the full premium and still stay on our plan with COBRA rights. So potentially, if they did that, and I don't know if we could guesstimate how many people would actually do that, right? They may have a spouse's plan that they have an option to go on to, or some other source of medical insurance that they could potentially utilize if they didn't receive this at no cost to them. So shorter answer is yes, we will try, but I just don't know how much we can predict if we will still incur some of those claim costs because people would go to COBRA.
Okay, so I guess I shouldn't be looking at it from a cost savings standpoint.
So we know for
Because they would stay on our
sure
plan
we would
under COBRA.
eliminate the 78,000, not to interrupt you, right? But the
Right.
claims would be the,
Okay, that doesn't seem like much of a dent. Okay, thank you.
And you said that the average number of months is like 4 months that people are on this. So if they were on it, they lost their insurance for 4 months, but then came back, it's a 0-day waiting, so they would be right back into their insurance. So I just think 4 months of premiums, I'm sorry, this is it's an important, I think, benefit for our employees who run out of sick leave. They're not getting a paycheck and they're coming back. There's a spot, there's a long-term, there's a sub in their room, or there's, somebody covering their shifts, and they're coming back in many cases, not all, some died and whatever, but giving them 3 to 4 months of health coverage till they can get back on their feet, I think, and when they're in their most desperate and most vulnerable and most, I just think it's a great benefit that we have. I do understand that with the 0-day, somebody coming on, working one day, and then boom, going on the leave is a concern. And I think that having, in the past, a 90-day waiting period before you got benefits, saying that we want to do the same thing here, where there's like 90 days before you could qualify for this benefit, or even if we wanted to say that we wanted to do 6 months or something like that, I could definitely understand it. But you said that many of these people, I think 27 years with the district was one of them. I think with the vast majority of the people that we see in those numbers are not people that have even been here 90 days. Most of them have been here for a longer period of time. So I don't want to personally jump. I don't see jumping to like elimination. I don't think we would save that much anyway. Sorry, Don.
Yeah, I also want to support keeping the benefit, because as I look at the percentage, the employees using this are the ones that are the least paid in our district. So I think this is a great benefit, but I also agree that we need to go with 90 days to 6 months as a employment period before you can have this benefit. But I would not vote to get rid of it, looking at who's using it, because that has me very concerned about the people who work with us.
You can. This is an action item, although once the motion's made, then I open it up for comment before. After discussion, okay.
For the record, Jeff Balzo, so after Laura's explanation of that it would just be the $78,000 savings and not the 1.1 million, which I thought it was on the next line item,
Yeah, the
would
1.1
like to
would be
withdraw my
unpredictable of if people would elect other insurance outside of the district or not.
okay. So yeah, I don't need to see it as an option at
Okay.
the next meeting.
Okay.
Don Echeverry, for the record, I move that we add a 6-month waiting period to the waiver of contribution. Is this waiver of contribution benefit?
Is there a second?
Tony McMillan, I'll second the 6 months.
Okay, it's been moved and seconded. We move for go to a 6-month employment before the benefit kicks in. Discussion.
For the record, Jeff Balzo, do we have to, Don, you said waiting period. Doesn't it be more along the lines of length of employment
I'll
prior
accept
to?
that as friendly.
Okay, thanks.
Rachel?
Okay, so Rachel Drake, and just in discussion, I can see 6 months, given the impact of this, that somebody works for us for 6 months before they're able to access this. I also want a cognition amongst this body that we are crafting new language on our plan. that because we're going to the 0-day waiting period for all benefits, except this one, we're setting a standard. And I'm not sure I'm comfortable with 6 months being the standard that we're setting. So I would entertain a shorter period, whether that's 3 months or 4 months, because we have been functioning with 90 days, and we're still, and granted it's 1 year's worth of data, seeing that most people who are accessing this benefit have been employed longer than that.
So I'm not going to make that change since the motion's on the floor. It'll have to be voted down, I believe, Mr. Chair.
Yeah, I think we have to vote on the motion, or unless it's amended, but
Well, is there other discussion? I don't know where everybody else
Yeah.
is sitting.
I personally have, I think that, you know, looking at the numbers of people, it would be very few that even 6 months would, at least in the last year's data, really impact that much. And I think that, you know, when we look at the fact that no other plans that we know of have this benefit, and I know from friends who have benefits at other places in town and casinos and stuff, you know, they don't even, some of them don't get benefits for 6 months anyway. So I think it's a really good compromise. I mean, we could always come back and lower it down to 90 days later on. Once we have some data to look at, and maybe if we track that data for a year or two, but I don't know. Is there further discussion? Okay, so we have a motion on the floor. Before we vote, I'm going to open it up for public comment. Is there any public comment? Seeing no public comment, we'll go ahead and vote on the motion. All in favor of the motion to move to a 6-month waiting period before the waiver of contribution benefit kicks in, please say aye.
Aye.
All those against say nay. Sorry. Okay, motion passes. Next item is the wellness, the one that we moved, right? Okay. I'm trying to look and see which number that's. Okay. 2.03, presentation and discussion of the Washoe County School District Group Insurance Program report to cover current events and programs as of April 2023 for presentation and discussion only.
Hi everyone, Mackenzie Howard for the record. For the first wellness program update, I brought our CompPsych utilization report so we can look at this at a quarterly basis as opposed to just the yearly rate. So the first column we'll focus on for the first chart is the Q1 report. So this is looking at data from January 1st through March. So we can see that our utilization rate was lower compared to Q1 of 2022. But the last two columns show that we're not terribly off. So I think that we could end up around the same utilization rate. Of the total 161 members that did utilize CompPsych this quarter, our primary issues were very similar to last year's totals. The only one that was not included last year was family and child issues. So that's a new one. Our next update is our Healthy Habit Challenge for June. We'll be rewiring our stereotypes, and this will be held June 12th through June 18th. And last, our race reimbursements are due tomorrow. So if you ran a race in 2022, we can reimburse you for up to 2, but you have to submit that paperwork by tomorrow. Any questions? Go ahead, Rachel.
Given the addition of Care Solace to the options that our employees have to access, are we doing anything to coordinate what's going on between CompPsych and Care Solace, or the other way around, that kind of thing?
So Cara Solis is aware of the 3 free counseling sessions that our employees are given. So if an employee isn't aware of ComPsych, but they reach out to Cara Solis first, they will relay that info so they do know that there's free resources for them. Yeah.
For the record, Jeff Balzo, on the family and child issues, do you have any more detail on what that is? Or is that just a general category and that's all we get to see?
As of right now, I think it's just a general category, but I can look back at the utilization report and I can reach out to our account manager to see if he has any more specifics for us.
Okay, yeah, I would just be curious to see why that jumped onto the primary issue, or jumped to the primary issue from not being on the list before.
Right. I mean, it wasn't even in the top 5 for all of 2022, so I think it is something to look into.
Okay,
I can bring that next meeting. Yeah.
Thanks.
Any other questions? No? All right. Thank you.
Thank you very much. Okay. 2.06, approval of the minutes of the April 26, 2023 meeting of the Group Insurance Committee. This is for possible action. They were emailed out. Did everybody get a chance to see them?
Oh.
Go ahead, Jeff.
For the record, Jeff Balzo, at the bottom of page 1, it looks like Joseph's last name is spelled incorrectly. That's all I saw. Thanks.
Any other corrections, concerns, or motions?
Donna Echeverry, I move that we accept the minutes as amended or corrected.
Jeff Balzo, a second.
Okay, it's been moved and seconded to accept the filed minutes as presented and amended. Any discussion? Okay, all in favor, please say aye. Oh, public comment on the minutes? Okay. Is there any public yeah, sorry. Any public no? Okay. Seeing none, all in favor, please say aye.
Aye.
Opposed, nay? Okay, minutes have been adopted as amended. Okay. 3.01, public comment, any comment? Okay. The 14th. That's, okay. The announcement of the next meeting at 3.02 is June 14th, here at 4 o'clock in the boardroom. And without objection, we will adjourn the meeting. We are adjourned.
I am unsure if it is obvious. I did not vote on Dawn's.
Yeah, I saw.
So, I don't know if that matters, but
Yeah, I put